Hello everyone, and thanks for tuning into the Financial Investor channel. My name is Brent, and today we're going to be doing our weekly recap for November 5th through the 9th, 2018. We're going to try and make this video very quick. We're going to go over what happened over here on Facebook, our articles that we posted out, go over the four main indexes, take a look at the emerging markets, 24 hours, take a look at stocks here, stock futures, positive, negative, going into Monday. I hope it's negative. I like the buy low market. What stocks traded here actively in the after hours? Take a look at one stock I was eyeing this week. That was Activision Blizzard. We saw the announcement of the mobile gaming device. Everybody hated it. It had way too many dislikes in comparison to likes. All my friends thought it was hilarious. We're going to take a look at home builders. Oil had a huge sell-off this week. We're going to go over some news on that. Take a look at the dollar getting stronger. It's hurting oil, silver, bonds. And then take a look here at the market recap here for Merrill Edge. We'll go through here and kind of read that through at the end here, just making sure that I don't get logged off the site as I'm going through here. So over here on Facebook, I posted an interesting snapshot I had of another Facebook group. This individual has $641,000 invested in assets paying dividends. They have a yield on cost of 9.32. Now, you can see here, I posted all screenshots of their portfolios here as they mentioned them with the little snippet of how they describe their portfolio. This individual makes an average per month in dividends of $4,946.50. So there's a lot of investors out there that really hate on dividend investors or say you need $3 million, $4 million, $5 million to retire. This individual has $641,000 of assets paying dividends, and they're able to make $54,000 of just straight dividends. That gives them an average payout of $4,946.50. That's the power of compounding and having dividend stocks raise their dividends year after year for the Johnson & Johnson over 25 years, ADP, Procter & Gamble, multiple companies out there have been raising their dividends for 25 years. So this is just, everybody thought that was really inspiring over in the dividend groups. Now kind of jumping on beyond there, I posted about closing on my second property. I already have the roof done. I have the flooring done. We're taking a look at the heaters. I think we'll have to replace the heaters. The sellers called me up. My realtor called me up saying that the windows came in, so the windows are going to be going on. We're going to be power washing, trimming, and doing a fresh coat of paint here within the next week. My other one is done. This one should be done either here in the next week or the following one. I have my inspection on the 24th. I'm taking my wife, my kid out there. We're going to be walking through our properties, showing my kid the power of buying assets that are going to be able to provide cash flow. These will be here on the market here pretty soon, and then we can get the full numbers of what they're going to be renting at and what their expected return should be. So that'll be another video coming up. Apple took a hit last week, and of course I bought Apple going into Monday, bought it at $199. So that was a nice little lock-in earlier this week. We covered 5 stocks going ex-dividend next week, November 12th to the 16th. Home Bank Shares, Gorman Group, Applied Industrial Technologies, Provident Financials, Simon Property Group. So quick disclaimer, this is one I own, but it made it on the list all on its own, having raised its dividends over the last 5+ years, increasing revenue, net income, free cash flow for all of these. So interesting article if you guys want to check it out. I posted last week about CDs. Goldman Sachs, Marcus over at Goldman Sachs has a 2.10%, I believe, 2.15%. I'm not going to scroll down, but they have a no penalty certificate of deposit, but they also increased their high yield savings account. You can see here, I started my high yield savings account over with Marcus Marcus by Goldman Sachs back in March or April of 2018. I've made roughly $150 of just earned dividends while I was there. So very nice place to have cash if you have, any cash that you don't want to have invested in the market, dealing with that volatility. You want to have a nice little rainy day fund. My wife feels a lot better when I'm not completely invested in the market. So we have a couple, a little over $10,000 in just our savings. That way it'll last us a little bit. Plus we get other passive income elsewhere. And then my business is also funded. So all those here that are just looking for a place to store your cash, here's a great area. 2.05%. You put $10,000 in there, you're going to get $205 plus a little bit of interest, that compounds monthly. I have a little calculator here. If you click on the link right here, it's going to go into my spreadsheet here. If you put in some money, you can see over time you'll be able to capitalize and build up your dividends. So right now I've been in with Marcus for about 7 months, 10 minus 3 back in April. So 2, 4, 6, 8, So yeah, 9 months. That puts me at about $154. So somewhere in that range is how much I've made in dividends. And I just kind of shared that screenshot there. So by the end of this month, I should be sitting there at around 150 some in earned interest. CNN. Also, back when I started with markets, they had a rate of 1.7, then 1.8, then 1.9, then 2.05. So they've been increasing here steadily. Midterm elections, everybody liked the split. They like Democrats and Republicans split there. So the Wednesday started very strong, over 0.5%. Initially starting up in the day, we saw the stock futures. I posted this at 1 in the morning, saying, you know what, Wednesday we're going to see a very good day after mid-elections. Markets were already hot, and guess what happened on Wednesday? Well, the markets were on fire. All indexes up 2%. Besides that, Russell 2000 up 1.67%. So everything did very well there. I see a lot of comments here that double patting myself in the back there because he made big there, I suppose. Fed came out Thursday. They're not going to be raising rates. That was completely already expected. That made the dollar stronger. That made gold weaker, and a few other little things in there. But they're expected to raise rates here in December by another quarter, and then 2 or 3 times additionally in 2019. I went over a video covering some questions as far as ETFs, how to invest initially if you're getting into the market very fresh. Activision Blizzard was my stock pick for this week as far as one stock I was really eyeing. I was invested back in 2017, between 2015 and 17 with Activision Blizzard. I know I've purchased one in the past, but here my fill price for this one was $49.33. So I'm supposing, or I'm kind of estimating, I don't estimate or expect Activision Blizzard to fall to that $50 point. They have so much going for them right now. They've released so much new content. They got vanilla World of Warcraft coming out. They have the mobile device coming out. People overreacted on this. I think this is just overreaction of their mobile release of Diablo 3 Immortal. And a lot of my friends, I thought it was hilarious. Everybody on my other friends are kind of investors as well as far as they're gamers. But they thought it was just a huge overreaction. This stock fell just 30% in just less than a month, though. So you don't get that stock at that price very often. So it may continue to fall to about 50. I thought it would be interesting to kind of pick that up as a gaming stock. I don't have any there. Great sell-off on Friday. I like sell-offs towards the end of the week because that means that on Monday everything is so much cheaper. So oil may just go down nice plunge there from oil, and then just the markets continue to sell off there towards the end of the day. I really like those sell-offs. So I have, of course, my $330 going into the market in 66 hours, 15 minutes when I posted that, and that'll buy me about 13 individual stocks there, kind of averaging all my stocks either up or down within my portfolio by target or by actual to target percentages. And then there's all of our weekly changes for the week. I didn't include what made me move up the most or the highest. I suppose I didn't really track that across all my stocks. I think Apple kept me down the most this week as far as percentages wise, but we shall see. It was a bit of a slow week. Everything kind of, Wednesday was very nice for everyone. So that is the Facebook update. Now on to the indexes. As we saw here, S&P 500 moved up 2.13% this week. Very nice there on Wednesday after those mid-elections. Everyone actually was pretty positive going into the mid-elections, and then here we had that split, and everybody really liked that. Up 5-day change, 2.13%. Year-to-date up 4.02. Dow Jones also continuing here 4 days, even during the Fed raising their rates, or keeping their rates. Normally, S&P 500 sold off a bit there, down a quarter over there. Thursday, as Fed came out, the NASDAQ sold off about 0.5% there, but the Dow Jones actually stayed pretty flat throughout Thursday. I thought that was really interesting. I was expecting them to come down a little bit as well. And then Friday, everything kind of sold off here, especially technology here. S&P down 0.92, Dow Jones down 0.77, and then tech here, the NASDAQ down 1.65%. So 5-day change for them, only up 0.68. Ooh, did I get that wrong on my Facebook? 0.68. NASDAQ. Oh, no, I got it. 0.68. Okay. So I like to keep track of what happens every week. And by posting it over on Facebook, I can just look either here on Facebook or on my YouTube channel and see, okay, you know what? We've had a couple of weeks here of positive. We're going to take a breather probably in the next few weeks. And if we go down 2-3% because we've been up 2%, that's completely fine. So next week we may take a breather. Emerging markets took a breather. As you know, we've went over them last few weeks. They have just shot up very nicely, so that you can see here, coming off their lows of around $34, $35, hit all the way up to nearly 42, 43, and they took a bit of a breather, just kind of exhaling out. So they took a big inhale, and then they're just kind of exhaling out. So next week they could trend sideways here for a little bit. They may pull back a little bit more, or they continue moving on their way back up. So stock futures right now currently looking flat. We don't have a lot of news right now that's either going to move the market up or down. That'll happen throughout the weekend, or some sort of announcement. But their billionaires are really pushing on President Trump to make a deal with China. So if any sort of news comes out, Trump comes out saying, hey, we're in talks with China to make some sort of a deal, the markets are going to really like that going into next week here. We can see a lot of tech stocks here towards the top here, sold off. I saw US Cellular, T-Mobile up here, 21st Century Fox down there over 2% within those. A lot of tech, so that may have affected the NASDAQ. AT&T, Apple here in the after hours. Zynga, interesting one. I believe they're the gaming stock. I think I held them for a little bit. Walmart, those are the consumers. If you're looking right now, if you're selling off half your portfolio to kind of alleviate risk, look for those stocks that are already down in that bear territory for the year. You know, as you know, we talked about this in the past. The S&P 500 market weight, it's market weighted by the market cap. So a lot of the strong stocks, the FANG stocks, those have held up. The S&P 500 going into 2018, those have been propelling the markets higher and higher as Facebook, Amazon, Apple, Netflix, Google, Square had moved the market higher. 40% of the other stocks within the S&P 500 were actually down for the year by 20, 30, 40%. So a lot of these, if you need to, look for some diversification, alleviate some risk there, and look for those funds that have been hammered here recently, and wait for either a downturn or wait for those other stocks to kind of come back out of that bear territory. Activision Blizzard this week, we took a look at it. I was really eyeing this one. I'm kind of considering taking a position in this one. It did move down over 30% from the 1st of October till currently. So here we can see just the 1 month chain here down 25%, but if you tack on from the 1st of October, it's actually down over 30%. So Activision came out with their mobile Immortal or Diablo Immortal. Everybody, 100,000 plus dislikes with very few, a couple thousand likes on their new mobile platform. It was basically a Chinese knockoff reskinned for Immortal, and nobody really liked that. Then there was a bit of a whisper here in the after hours that Diablo 4 announcement, but we shall see on that one. I think it was an oversell. I believe Activision Blizzard had some really great products. I was already an investor in them in the past at $50, so if this one falls, I see a lot more uptrend and downtrend here. If I look at this graph here, I mean, even they believe the forecast of this sees much more upside than downside potential. This is all green potential, but with this huge sell-off of 30%, that I believe this puts them more at a non-risk level. I don't know the keywords for that, but home builders took a breather, as you know, over the last few weeks. There was a huge buy-in during this downturn. Once they hit that $31, $32 point, huge move into the home builders. This one had been kind of steadily selling off for the past couple months here. You can see as of September 2018, as everyone got that hype that, oh my God, the markets are, the housing markets are tapering off. Everything is going down by 10, 20%. We're going to have another market crash. This one started to sell off here, but investors saw this as a steady trending, and then bought at that dip, and it's taken a bit of a breather. Again, same with the emerging market. So it went up very nicely just over the last month or so. Not over the last month, just over the last couple of days, I suppose, but it's taken a breather. Oil sold off 4.5%, and this is all due to here. You can go ahead and stop the video, pause it, read through here, but the U.S. sanctions against Iran didn't come off as we had thought. They had actually got a very softened waiver, allowing the majority of the imports from area for Iran to just kind of continue, which, that didn't help us. There's an extra supply and demand. If there's extra supply, not enough demand, that drives the oil prices down. That really hurt them this week, towards the end of the week. That's what also hurt the S&P 500 there. So here you can kind of read through it if you would like, but I like having sell-offs here towards the end of the week. And then also dollar continuing to get stronger here after Fed announced that they're going to keep rates as they were. That's when the dollar turned around and came back up very high. Here's the announcement towards the midday, and boom, dollar gets much stronger. And with the dollar getting stronger here, Dow ends 200-point high as unraveling oil prices. Now this is back with oil. I was going to chat a little bit about this with oil, but if you guys would like, you guys can pause it and read through it. I was kind of just reading through it. Talks about where the market was kind of heading, what the strategies are saying about oil, and where it's kind of heading as far as the market. Tax reform should have really helped out the market with all that cheap money out there, but as the feds are raising rates, that's causing that cheap money that everybody took out to, it's getting more expensive to hold, especially with the dollar getting stronger away. So it's kind of like a double-edged sword. The dark side of midterms that may stop the S&P 500 from bursting through its ceiling. So I'm going to cover that one. And interest rates. Yeah, we talked about interest rates. Silver, as you know, the dollar getting stronger, that just does not hurt. That does not help silver. Plus, I don't know where the bottom of silver is. This was I really don't know where silver is going to be heading at this point, or gold. A lot of people have been buying into silver, gold, and bonds. I don't see them as safe investments. I think you're better off buying a low, a high, not a high yielding stock, but a stock that can withstand the downturns, like a consumer stock, not technology, like healthcare. I think you're better off buying a nice consumer branded stock versus trying to buy silver and gold at what you would believe is a discount, only to lose 3-4% in a single week, from the markets. And this could continue to go on. And if we were going to go into a bear territory, we may not see gold or silver recover even during the downturn. So gold continue to sell off here. Gold continue to sell off here. So sharp losses for the stock for the sessions, partly tracking the plunge into the bear market for oil. So failed to limit gold downside. Even so-called risk-off settlement contributed to the rise in bonds. So here we can take a look at bonds. Bonds did move up very slightly, 0.23%. Bonds are, sort of that hands-off investment. You invest in it, gives you a yield of around 2.5%, I believe. But here you would actually be down year to date, down 4.77 if you had been investing in bonds. That yield may be going up, but the actual price of it will be driving down. So you'll actually kind of balance yourself off there in a way, but you'll actually have to pay interest on your, you'll have to pay taxes on those dividends. So it may be better just to hold cash. If you're just trying to stick money somewhere, earn some interest or some dividends, if the market's not going to be helping you out anyway, staying flat, it's going to be causing you to go down. You're losing 5% of your portfolio worth, and you're only earning 2.5% yield, dividends, and you're going to have to pay taxes on those dividends. Is it really worth holding the bonds to kind of alleviate that risk? You're just kind of negatively impacting you, and then plus you're also having to pay taxes on it anyway. So the last yield here currently, we had 3.23 last time. I think that was maybe Thursday after the Fed came out. And then here, as we close, 3.19% on that 10-year. Prime still remains 5.25 until December, where it will bump up to 5.5. 1 year ago, you can see that we're a whole percent up over last year. That causes housing markets to kind of be like a 10% discount there. So you lose 10% of your buying power for every point, and 5% of your buying power for every half a point there. So maybe it's every half a point, it's 10% of your buying power. But that is basically all I have for you guys as far as all the markets kind of go. So here, weekly recap: the S&P 500 rose 2.1%. Weathered a late week sell-off that was mainly with the Fed Reserve coming out. Upbeat reactions of midterms. They came out saying, oh, the market's where it's expected, it's on fire, but they didn't want to raise rates. I don't know what's wrong with my mouse. So everything, is as expected. It split Congress, with Democrats taking control of the House and the Republicans taking control of the Senate. So the prevailing assumption when the market was it was newly divided. Congress could preserve the market-friendly policy. So instead of Republicans all sitting in there and trying to, there's actually going to be some sort of a standoff. You can't. The Republicans won't just be able to pass anything they want. The Democrats won't be able to just kind of push everything they want. They'll be having to work things out and sort of be friendly for both ends. So they believe that's going to be really helping them out. Healthcare did really well this week. Real estate did really well this week. I don't know if I talked about it in one of my earlier videos, but I think that I talked about healthcare, I talked about real estate and utilities and consumers being the stocks that you should be kind of focusing on during this time of market. We're at these high peak market right now. We're kind of unsettled. So if we even take a look here back at the markets, we can see here healthcare, consumer, non-durables. Again, I don't know if I talked about this in my other video. I may have talked about healthcare, consumers, utilities, and I don't like finance. I don't like technology during the downturns unless they're services, technology service-based companies. So I talked a little bit about Apple and Cisco. Even during downturns, a lot of those, they come out with some very good services. So that is basically all I wanted to cover there. You guys can kind of just pause. Disney's going to be making that huge announcement. They made the new trailer for their Marvel, what was it? Marvel Infinity War. It's not Infinity War. It's the next one over that. I don't think they chose the title yet, but that should be coming out May of 2019. That'll be very nice for Disney there. General Jeff Sessions, he got replaced earlier this week, and here we can just take a look at the total treasuries for the week, which we've already kind of discussed. So that is basically all I wanted to cover in today's video. What are we at? We are at 21 minutes. Well, I went way overboard as to what I really wanted to cover. So hopefully you guys did enjoy the video. Of course, if you did, hit that thumbs up button below if you learned something during these weekly recaps. Let me know in the comment section below if anything I may have missed. If anything helped you out, what do you guys think about Activision Blizzard? Where do you think the market's going to go? Do you think that the S&P 500 will sell off due to the FANG stocks holding the market up? Are you invested in some of these bear territory stocks, that have already came down and are actually looking at some very, reasonable levels? Let me know in the comment section below. I always like your guys' commentary, and I really enjoy responding and reading through it all. So let me know as much as you want in the comment section. If you want to write me, you can always email me at financialinvestor101@gmail.com. Of course, a quick disclaimer, I am not a financial advisor or tax professional in any way. The information provided is my opinion for entertainment and fun. This is not investment advice. This is just me as a financial investor trying to help others make their money work for them. Thank you all for tuning in. I will see you next time. Have a great day. Bye.